Welcome to another episode of Stately Investing with your host, Burnett King. If you like the content I'm putting out there, give us a thumbs up. If you love the content I'm putting out there, give us a subscribe. It really helps the channel. If you have any questions, feel free to leave them in the comments section or send me an email at statelyinvesting@gmail.com. And let's get started with the show. Welcome back, everybody. In today's episode, we're going to talk about what I would do if I had $10,000 to invest as of today. So we are in late April of 2020. We're still under the impacts of the coronavirus and figuring out what that means for the markets. But what I'm getting from some people, questions I get from some people are around, is it a good time to invest? The market is highly unstable. What should I be doing with my money? Should I just be hoarding cash and wait? And the advice that I always give them is you can't predict the market, right? The market always has volatility. So right now we might be experiencing more volatility than normal due to, circumstances that aren't necessarily financial. But I think it's always a good time to invest in the market. So, this channel is about dividend growth investing, so long-term investments. And I think it is a good time to get involved in the stock market. I don't think you should wait. Waiting would mean you're trying to time the market, and I just don't think that works over a long period of time. If you're a short-term investor, and have a different strategy, that's a whole other video, right? But I think for most folks watching this channel, you're interested in dividends and how to grow those dividends. And I think getting your money in the market as soon as possible is the best way to do that. So we're going to do some simulations here today, and I'll show you how I built this portfolio of $10,000. So if you check out my video from last week, I mentioned dividend aristocrats, the S&P 500 dividend aristocrats. And so this is a group from the S&P 500 that have grown their dividend payouts for 25 consecutive years, right? So it's an elite set of companies who have focused on increasing their dividend over time. And I went to Wikipedia and simply pulled the list, right? So you can just pull this entire list. And then what I did is I went into Seeking Alpha and actually ported the list in as one of my portfolios, right? So you see dividend aristocrats, and you put in all the symbols, and it gives you the data for them. And it gives you a lot of data, right? So first I looked at the performance tab, and I wanted to figure out, okay, what were the key metrics? So as this is an interesting time, I want to look at a couple of metrics that would indicate good buys for me, right? So I looked at 6-month performance because a lot of stocks are negative right now, meaning their price is lower and they have pretty good dividend yields. And so I want to focus on companies with good dividend yields and the potential to also bounce back to where they were before or higher, right? So I wanted to focus on short-term losses, so 6-month performance for me, and then long-term returns, which was 5-year total return. You could also look at 10-year total return, but there's a lot less distinction in those. Like everybody looks positive here, so I wanted to look at 5-year. I think that's a reasonable investing time frame. And so I put all of that information, or at least that performance information, into a spreadsheet. The other metrics that I looked at were growth. So I wanted to make sure the companies were growing. So I looked at the metrics that I pulled were revenue 5-year. So is this a company that is growing their revenues every year? They're not in a declining industry, etc. And then I looked at their net income over 3 years, right? So this is essentially their profits, and making sure that even if they're growing revenue, they may not be profitable. And so I wanted to look at their profits as well. And so those were the main focus areas of my spreadsheet. So you can see I have a dividends aristocrat tab here, and I put all of that in for the entire list, right? So I looked at all the dividend aristocrats from Wikipedia and put all of that information in. So you see 6-month performance, 5-year return, 5-year revenue, and 3-year net income. And then what I did is I took the averages, the standard deviations, and put like a high mark and a low mark and color coded each one of those metrics. So I looked at 6 month performance. And for this, I wanted your 6 month performance to actually be fairly low, right? So the more negative you are, the better. I looked at those and marked any that were, a standard deviation away from the average. I marked them as green. Anything that was a standard deviation above the average, I marked as red. Same. And so then the other three metrics are actually the opposite, where I'm looking for positive numbers, right? So your 5 year return, your 5 year revenue, and your 3 year net income follow the same process, color coded them all. And so then I essentially started sorting those colors. So I'll show you really quickly how you do that. You can go in, put a filter in, and this is in Google Sheets. You turn on the filter and you look at your 6 month performance. You filter by color, and I have this light green, and it shows me the companies that end up having pretty bad performance in the past 6 months, right? If you notice, a lot of them are also bad in their 5 year return. So that's telling you that the company may not be your best investment at this time. Some of them, however, were like neutral. And then some of them had really good 5 year revenue, and some had good net income. But I also didn't just base it off of the 6 month performance. So I would clear this filter out and then do the same thing for the next column, right? So look at my 5 year total returns and see, okay, so Cintas Corporation, they didn't necessarily have the requirements for the negative 6 month performance, but they are green on all my other categories. So I looked at this. I won't go through all of that right now for you, but you can see these are the companies that I picked out. So ignore the first line. We'll talk about that in a second. But these companies here were companies that I thought were safe investments for this period of time. So if I had a fake $10,000, these are definitely companies I would invest in. They mostly were green on all of their metrics. The only one that was not was Abbott Laboratories. They've just been kind of killing it through this coronavirus in the last 6 months. And so they aren't particularly negative. They might be, highly priced right now, but the rest of their metrics looked really good. The remaining companies here in yellow, like I always wanted to keep a diversified portfolio, and so that's why you also see this detailed sector. So I looked at some other companies that might not necessarily be as strong performers on my metrics, but had decent enough metrics that I would consider them. And then this line up top is bonds. So I think because of the extreme volatility that we're facing right now, I think that it is smart to have some money in bonds. A lot of people are actually taking money out of bonds to buy stocks because they think we've hit a low and it's time to invest. But I actually think we're really volatile, and especially if you're a new investor, having some stability in bonds is a smart idea. And so just happens to be the bond fund that I think is a smart investment. The Vanguard long-term bond has really low expense ratios. I tend to go for long-term bonds. You can go for short-term or medium-term, but the long-term bonds, if you're not going to take that money out and you're really going to let it sit there, it gives you a pretty good return. As you can see, the 5 year return is not bad on those. So I automatically allocated 20%. So it's kind of this 80-20 rule that you'll hear about with bonds. I allocated 20% towards my long-term bonds. So the rest of these, I started figuring out, okay, what percentage of my portfolio would I want these to make up? And so I did that for each one of these companies. I think, the only one that was kind of green across the board and is super cheap right now is Cincinnati Financial. They're in insurance. That's their kind of detailed sector. That's probably why they're so negative right now, right? But over the long term, I think this will bounce back pretty significantly. So they were also 20%. Another one that I previously mentioned was Cintas Corporation, right? They're kind of commercial services and supplies. They provide a lot of different kind of corporate activities and corporate supplies. So this had kind of greens across the board. It wasn't green in my 6 month performance metric, but that's why I allocated at 10%. So you can kind of go through these. You see I have a wide variety of industries here, basically something in everything, right? So the only REIT here that I think is a super great deal is Realty Income based off of these metrics. REITs, are kind of a risky investment because it's real estate and potentially we're going to enter a recession. But overall, I think Realty Income is suited to make a good recovery once things are over. And so, yeah, I wanted to make sure my sectors were kind of spread out, that my allocations were dedicated to those companies that I thought would have the biggest returns. And then what I did is I made sure that all of that equated to the 10,000 number to get this to total up to 10,000. And then I equated how many shares that is. So I did all of that. I think this gives me a good number of stocks, right? This gives me a 14 essentially different things to invest in. I think that's a solid number if I were just starting out investing. And then what you can do if you don't necessarily have 10,000, you can adjust this down to whatever amount that you have, right? If this is $1,000 or $500, like the good thing about using like M1 Finance is that you have fractional shares. And so you can actually just purchase what you think is best. You can actually set up your pies to match these percentage values, and then it will automatically kind of do the math for you, right? And purchase the correct number of shares, no matter what your amount is. And so that's one thing I love about M1 Finance. The other thing is if you aren't ready to invest, let's say you have nothing, right? Let's say you don't have any cash, you're kind of struggling, but you want to know what these companies could do for you in the future. There's this this platform out there called Webull. The nice thing about Weebulls, they're similar to a lot of these other investing mechanisms, investing corporations. But the one thing that they have that I like is this paper trading account. So you can set up a fake account, and these paper trades aren't actually doing any real transactions, and you can just kind of track how the investments look over time. So what I think I'll be doing, and we might make some future videos around this, is what does this account look like? Let's set this up in Webull in a paper trading account, and let's see the performance, right? Let's just look at it and see if the performance on these stocks is any good. And then we can kind of watch and see over time. So let me know in the comments if you think that's a cool idea, and if we should make some videos and kind of track the performance of this account versus my real account, and seeing what, if I was starting over again and took this approach, would it be more successful than what my current account is doing? So speaking of that, let's jump into my real account, my passive income in M1, and see how it's doing. It's at 12,602 overall. Return is down around 10%. You can see for the week, I'm down around 1.79%. So slight dips in market gains, not a ton of earned dividends. But overall, this week was pretty flat. Nothing too crazy, like we might be stabilizing a little bit here, but we'll see what the future holds. If we look at my activities, let's see what kind of dividends I got over the week. All of these are actually from like last week. So none of these are really attributing to this week at all. But I think overall, my view on the market this week was stability, right? People are thinking that with the economies coming back around the world, and specifically in the US, that people are questioning, they're uncertain, they're unsure around how quickly we can get things back to normal, or are things going to need to remain closed down for a while. A lot of states and the federal government are kind of recommending that we open things up slowly or in phases. So I think there's some uncertainty built into these numbers this week. I think last week was more of a shift to, things are going to open back up. The market was very happy about that. So we'll see how things play out over the course of time. I think as we get more realistic numbers around unemployment, I think we will start seeing some dips in the market. But like I said, there's, you can't predict the market, right? If you could, you'd be a billionaire. And so investment strategy should just be, let's get started. If you're just starting out, you can always start out small. I wouldn't try to make any super risky bets. I would take a kind of realistic approach. And again, I recommend doing your research on these dividend aristocrats. They're a great place to start. You can learn more and then kind of branch out from there. So I think that'll be it today for the video. I hope you guys enjoyed it. If you liked it, give me a thumbs up. If you loved it, give me a subscribe. I hope you're all staying safe out there, and I'll see you again next week.